And right now, we're at 60 something thousand, predicting that Bitcoin will go to 250,000 to a million. Wide range, but very useful for me. Everybody has to make that decision for himself. But right now, we know where we are exactly in the market cycle, which is a bull market, red. Please don't look at the exact number. So for example, that Bitcoin is 64 and 2000 below the 66 5 months realized price. That's not really important. What's really important is that in bear markets, this short-term moving average, short-term realized price goes below the 2 years realized price and below the entire realized price. Same happened here in the bear market, same happened here in the bear markets. And in my opinion, we just started this greed phase, this bull market phase, and RSI will increase from here to, let's say, above 80, possibly 90 again. And that would be like 2013, 2017, and 2021. So that's what I think.
Plan B begins by addressing the common misconception that Bitcoin's price will remain below the S2F model line due to recency bias. While it's understandable why some might think this way, he argues that there is just as much chance that the price could rise above the model line as it has in previous cycles. The S2F model, which forecasts an average Bitcoin price of $500,000 in the upcoming halving cycle, is built on historical data showing that Bitcoin typically fluctuates within a wide range around the model line. This range could extend from as low as $250,000 to as high as $1 million in the next cycle. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Most people, because of recency bias too, most people think that this cycle will be below the model line again. And that's very understandable. However, there's as much chance that the model will be above the model line again, and like this period or this period. And in that case, I mean, the model line for next period is 500,000, right? That's about the level that we expect. And then normally we would go 2x over that, and 2x below that. So that's 1 million or 250k. So that would be the normal range around this model line. And by the way, that's another misunderstanding, that these ranges are so huge. Like here, for example, last period the model prediction was 50,000, and then the range was 2x that, 100,000, and divided by 2, 25. So everything from 25,000 to 100,000 was okay, and that's a pretty large and wide range. But on the other hand, Bitcoin has a volatility that's very large. It has a implied volatility of 80%, sometimes 100% in the option prices. So you cannot expect a model, which is a simplification of reality, and especially a very simple model like the stock-to-flow model, which only has one input parameter. You can't expect that to be very precise on an asset that has an implied volatility of 80%. So in fact, these ranges, well, everybody should decide for himself if that's useful or not. For me, having made this model at around 3,000, 4,000, predicting that it would go to 25 to 100,000 was very useful. And right now, we're at 60 something thousand, predicting that Bitcoin will go to 250,000 to a million. Wide range, but very useful for me. Everybody has to make that decision for himself. But right now we know where we are exactly in the market cycle, which is a bull market, red. Very different from the stock to flow that can predict in the future. So 500,000 average Bitcoin price for this halving cycle and 4 million the halving cycle after that. The Bitcoin market cycles model cannot see into the future. It can only detect in which phase it is right now. Bitcoin is in this red in the bull market at present, and it's at the start of a bull market because we haven't seen any movement yet. Now, I don't know when it flips to yellow, but as soon as we get there, I'll let you know. Now, note one more thing. The bear markets, the green, are very clean. The accumulation phase, blue, those are all very clean. Red and yellow is a bit messy. For example, 2013, that's the double peak bull market. It's flipped to yellow and then it flipped back to red. And ideally, you would have this dots not yellow, but still red, but it wasn't. So, of course, you go. Maybe you sell your coins here, you buy them back here, you make some loss, but that would have turned okay in 2013. And you see the same in 2021, which we all remember very well. And when the stock to flow, of course, didn't hit that 100,000, we were all a bit like, hey, what's happening? Where is this bull market? Do we only get a 6x? What's happening? Now, we see it. The cycles flip to distribution, to yellow, and then flip back to bull market again, to flip immediately back to distribution. So these two are a bit off. It's like this was the real all-time high, and this is just off. Now, maybe I can fine-tune these quirks in this model, but maybe I can't, or I want to keep the model as simple as possible, as clean as possible. So for now, it's still in there. And that will be very interesting when in 6 or 12 months' time, I don't know, we'll encounter that yellow dot, whether that's a fake end of the bull market or a real end of the bull market sign. But as I said, I'll let you know. And I use this model a lot as one of the two main models. Now let's go to the two technical analysis models. And it's always good to have multiple models, multiple perspectives, I think, not only in investing, but with everything. And it's also good to look at some old school technical analysis. So in this case, we look at relative strength index, RSI, which is a momentum indicator. Everything higher than 50 is an uptrend. Lower than 50 is a downtrend. A normal RSI range would be between 30 and 70. So, for example, if you measure RSI on stocks or bonds or whatever, it's between 30 and 70. So you can easily see that a traditional investor would make that mistake for Bitcoin. It looks at the RSI, it sees 65, it said, whoa, that's high, it's probably going down. But if we look at a historical chart of the RSI, like this chart, we'll see that the normal range is between 40 and let's say 90, not between 30 and 70. It's a lot higher for Bitcoin, which is understandable because Bitcoin has been in an uptrend for its entire life. Maybe that will normalize over time, but for now, it's fairly high, the RSI, and but so it's very useful because in this chart, for example, what does it tell you? You can see the bull markets, the bear markets. It's like the tides in the ocean. It's greed and fear and greed. And it goes on and on. It's human emotion that you see, and that will not change ever. So I think it's still very useful to look at these RSI charts. And RSI is 66 now, almost unchanged from 65 last month. That's consistent with the market cycles, right? The bull market, it's above 50, it's in an uptrend, and it's consistent with stock to flow charts, which says Bitcoin is undervalued. And in my opinion, we just started this greed phase, this bull market phase, and RSI will increase from here to, let's say, above 80, possibly 90 again. And that would be like 2013, 2017, and 2021. So that's what I think.
Plan B, discussing the importance of moving averages in technical analysis, particularly their ability to filter out short-term noise and reveal long-term trends. He focuses on the 200-week moving average, a crucial indicator that spans almost 4 years, aligning with Bitcoin's halving cycles. This moving average has historically acted as a robust support line during bear markets, including those in 2014 to 2015, 2018 to 2019, and the most recent one in 2022. During the 2022 bear market, Bitcoin's price fell below the 200-week moving average for the first time, marking it as one of the worst bear markets in Bitcoin's history. However, the market has since recovered, with Bitcoin now trading above this critical moving average, which continues to rise by about $1,000 per month.
Second technical analysis chart is a moving average. Moving averages are very useful to smooth out short-term random noise in the price data and to focus on long-term trends. Now, we're looking here at a 200-week moving average, so that's almost 4 years, which is really long-term, and I like it because it aligns with the 4-year halving cycles. I also like it because it always goes up. The 200-week moving average, the black line, always goes up. It has never ever gone down. So notice that this 200-week moving average was a support line in the 2014 and 15 bear market. It bounced from the 200-week moving average up into the next bull market. Then it was support again in 2018-19 bear market. And in the 2022 bear market, it crossed for the first time the 200-week moving average. So this was, if we look at 200-week moving average, the worst bear market ever that we have seen in Bitcoin. And then we also see that this moving average, this support, this historical support, turned into resistance. And luckily we broke that resistance and we crossed the 200-week moving average again. And we're now at, what are we, $38,000. And it's rising. This black line is rising every month at about, or a little more than, $1,000. Now Bitcoin is well above that 200-week moving average, as always, just after a halving, waiting for this bull market to happen. Very interesting, very useful indicator in my opinion. Now let's go to the on-chain indicators. There's 3 that I use a lot, and one is realized price. It's very unique data for Bitcoin, because only in Bitcoin and some other crypto we do have all the transactions rightly available, and we can make analysis on it. So please note that I calculate all the on-chain data myself with data from my Bitcoin node. Most on-chain analysts, they use third-party data, like the data from Glassnode. But I really want to do it myself because I've seen a lot of mistakes, and I want to check and double check all that data because I do have investments based on it. So this is my own data. Of course, I can make mistakes as well. Realized price is, by the way, comparable to the moving average that we just talked about. It's a weighted moving average, if you will. So what it does is all the 19 million Bitcoins and fractions of Bitcoins, all the fractions that are out there, all the 19 million Bitcoins out there are weighted against the last price that they transacted against. So the very old coins that transacted in 2013, for example, are weighted with a price of 100. But most coins are more recent, so they're weighted in this realized price with a price of 20,000, 30,000, 40,000, etc., etc. So then we get, if we weight all those Bitcoins that are out there, we get a price of $32,000 for the realized price. That's the black line, and it includes all the Bitcoins out there. If we only include the last 2 years, so the 2-year realized price, of course we miss all the older prices, all the low prices, and so that value is higher. So the 2-year realized price is 50,000 right now. It's a dark blue line, 50,000. If we make that period even smaller, like 5 months, we only look at the last 5 months. What is the realized price there? It's what is it? 66,000, and Bitcoin is slightly below that, of course, right now at 64. But it's, well, in the global general scheme of things, it's at this 5-month realized price. Now, what's very interesting, two things. It's and please don't look at the exact number. So, for example, that Bitcoin is 64 and 2000 below the 66 5 months realized price. That's not really important. What's really important is that in bear markets, this short-term moving average, short-term realized price goes below the 2 years realized price and below the entire realized price. Same happened here in the bear market, same happened here in the bear markets, same happened here. So, and the other way around too. If the bear market's over and this short-term realized price crosses the 2-year realized price and the realized price, the bull market starts. That happened here. It happened in 2023, last year. So we're now at the beginning of the bull market. The other interesting thing is that the short-term realized price acts as a support line in bull markets. So we have dips in bull markets. A usual bull market can have minus 20%, minus 30% dips. We just had one here. But usually it doesn't go really far below the 5-month realized price. So that's very interesting to see. It happens every bull market that we stay more or less above this short-term hodler 5-month realized price. Very useful. Second on-chain chart is the realized return. Those are the people that sold in a month. So last dot here is the July sellers, and they got 15% return. That's green, 15%. It's not much for Bitcoiners. It's a lot for traditional investors, especially if you make that in a month. But still, it's profit, so it's good. I mean, blue, that would worry me a little bit, and red is what I expect in a bull market. So that's probably what's coming next. Well, not really more about the realized return than Bitcoin in profit. We know from all the Bitcoins when they are bought, and most are bought below this level of 64,000. So they're all in profit. In fact, 92% of all the Bitcoins, 92% is in profit right now, and only 8%, so those are the people that bought at everything above 64, 8% of all the Bitcoins is in loss. In total, there's not much loss, not much fear in the market, which is good.
Plan B compares the moving average and realized price metrics. The 200-week moving average, with its steady upward trajectory, offers a long-term view that aligns well with Bitcoin's cyclical nature. On the other hand, realized price and its variations provide a more immediate snapshot of market conditions, helping investors understand where the market stands relative to historical buying levels. Both indicators are crucial for navigating the market. The moving average helps in identifying long-term trends and support levels, while realized price metrics give insight into market sentiment and the potential for price movements. By combining these tools, investors can form a more comprehensive view of the market, balancing long-term trends with short-term signals. Please like and subscribe my channel.